All right, I'm going to look at Parex. This is a company we actually recommended to clients years ago as a way to play energy, oil, and gas. It was a cash-rich business. It traded about the $5 range then. It's now 24 in that range. We don't have it in active coverage. We sold it at one point, but I'm going to get into the company today to look at where the business is now. Parex Resources, PXT on the TSX, trades around 24.63, $2.5 billion market cap, and pays a solid, strong 6% dividend. They are an oil-weighted producer focused on conventional high productivity reservoirs or reserves in Colombia, where it is the largest independent oil and gas company. Cash is on the balance sheet. Historically, right now they're in a kind of net debt position, but historically it's been cash rich. It has material free cash flow and an active normal course issuer bid. Parex has been well managed and is a solid international E&P company, which, despite possessing significant geopolitical risk, has outperformed the vast majority of Canadian exploration and production companies over the long term. So let's look at Parex's Q3 recent results here. As you may have expected, given the price of energy coming down over the past year, if you look year over year, revenues, EBITDA, and EPS were down. If we look at some of the highlights for this company, record quarterly average oil and natural gas production, 54,573 barrels of oil equivalent per day. That's an increase of 7% and 1% over the prior quarter. FFO was a decrease. And again, that was driven primarily by lower crude oil pricing and increased tax offset by higher production. The higher production is a good sign. Working capital deficit here, $58 million. That increased by $55 million as a result of timing of certain capital expenditures. We'll talk about that in a second. Management expects working capital in Q4 to be positive once again and build through 2024 with the forecast of production growth, declining capital expenditures, and inventory deployment, subject to commodity prices, as always, remaining in line with Q3 2023. So let's look at the guidance going forward. Parex's 2023 average production guidance is in the range of 54,000 to 57,000 barrels of oil equivalent per day, and CapEx for the year, which is a big CapEx spend this year, is expected to be 450 to 475 million. That remained unchanged. Building on strong current production, Parex expects Q3 average production of about to exceed 60,000 barrels per day. The company expects to release its 2024 formal guidance in January 2024. We'll look for that alongside an updated 3-year outlook looking forward, and that will be an excellent guide as to where we think the company can be 3 years from now. Now, building on strong production, the company is positioned to bring online 3 key wells over the remainder of Q4 2023, so we expect production to move higher. Valuations. The forward-looking valuation does look attractive at under 1.8 times what we expect 2024 EBITDA to be on an EV to EBITDA basis. Now, our take. It's been a tough 2023, the first half particularly for the company. One of their main blocks was shut down from January 21st to April 17th. That cut off about 66,500 barrels of oil equivalent per day. And Parex site, first site, the company's has this big swing portfolio that's looking at. It's targeting opportunities with the potential to produce 20,000 plus barrels of oil per day. It was unsuccessful. This led to a financial loss of over $55 million in Q2 due to asset impairment. We also saw higher CapEx, largely paid for from cash and cash flow, which is good, but the company continues to invest heavily for growth. They doled out over $156 million in Q3 as Parex drilled 16 gross wells in the quarter. That CapEx will likely recede in 2024. Key here, as always, is energy prices. Oil prices have declined from their 2022 peaks. They're currently off their 2023 lows, though. Once again, Parex continues to hold well above average geopolitical risk, but the valuation discount at under 1.7 times our expected EV to EBITDA ratio, it appears to be more more than compensating investors for the risk here. And if you want exposure to oil and gas, particularly oil, Parex is an option in that segment.
Yeah, I think like the reason we're seeing, or partially the reason we're seeing weakness in the price of oil is because of the U.S. hitting basically their highest production numbers that they've ever hit before. Like I'm looking here, average barrels per day at 13.1 million. So while we're seeing, U.S. production increase, we're kind of seeing Saudi Arabia and Russia's how much barrels per day they're doing decline. I did see in the news recently that Putin was visiting Saudi Arabia to, try to negotiate or talk about, stabilizing the price, because obviously as they're going through this war with Ukraine, they need the price of oil to remain high for the country. But yeah, it's going to be interesting to see, where oil goes here. Just, if the United States production continues to increase like it has been recently. But like you said, Ryan, if someone wants to take a play on oil, Parex is potentially one of the better names.
Yeah, there's a net debt situation right now, but as you saw there, management already expects working cap to go positive by the fourth quarter. And this company has always operated responsibly, not gone into significant debt. Typically, you see a significant net cash balance. They're spending for growth. I think this company needed to ignite growth to really drive the next, the next growth phase in terms of where the stock could be over the next 1 to 3 years. If they come out with positive guidance, which they should for the next 3 years, a 3-year plan, Parex is viable. We're continuing to evaluate it for clients. If the company does all the right things and oil goes down 20% this year, Parex likely doesn't do well. The same thing, if they do the right things and oil goes up 20%, it likely does well. If you want exposure, make sure you're paying attention to the balance sheet of the companies you're owning in this sector, because if prices go down, profits get squeezed, these companies can get into real trouble. And we've seen companies like cut their dividends, come down, and in significant, some companies have gone bankrupt in commodity-based segments. So you got to pay attention to that balance sheet. And there's some people that don't, and it's to their peril.